Key indices, your map to the market. Imagine navigating a vast sea of stocks without a compass. That's where indices like the Dow Jones Industrial Average, S&P 500, and Nasdaq 100 come in handy. They serve as our beacons of light, providing guidance into the overall performance of the stock market. What is an index? First, let's clarify exactly what a stock index is. An stock index is a group or basket of stocks that represents and measures the performance of a specific market, asset class, market sector, or investment strategy. There are many different indices, and three of the most popular ones are the Dow Jones Industrial Average, S&P 500, and the Nasdaq 100. Let's take a closer look at each one. Dow Jones Industrial Average. First, we'll start with the granddaddy of them all, the Dow Jones Industrial Average. Established in 1896, this index consists of 30 large US stocks. But what sets it apart? Well, unlike other indices, the Dow's value isn't based on market capitalization. Instead, it relies on price-weighted calculations. In simpler terms, the higher-priced stocks in this index have more influence, or weight, on the index's movements. Think of it as a popularity contest among blue-chip companies like Apple, Coca-Cola, Merck, and Disney. S&P 500. Next up, we have the S&P 500. Born in 1957, this index is like the big brother of the Dow. Many professionals consider it a better indicator of the stock market and economy, since it measures 500 of the largest US companies, offering a broader view of the market compared to the Dow Jones, with companies spanning various sectors, from technology to healthcare. The S&P 500 provides a more comprehensive snapshot of the economy's health. Contrary to the Dow Jones, the S&P 500 is a market-weighted index. Market-weighted is the most common type of stock market index, whereby the stocks are weighted according to their size, also known as market cap. Market cap is calculated by multiplying the price of a company's stock by its number of shares outstanding. For example, Apple currently has 15.5 billion shares in circulation at a stock price of $169 per share. Their current market cap is approximately $2.6 trillion, which equals 15.5 billion times 169. In the S&P 500 index, the higher the market cap of the company, the greater the impact on the movement of the overall index. Nasdaq 100 Composite. Last but not least, we have the Nasdaq 100 Composite. The Nasdaq 100 Index is a collection of the 100 largest, most actively traded companies listed on the Nasdaq Stock Exchange. Like the S&P 500, the Nasdaq 100 Index is also market-weighted and includes companies from diverse industries like manufacturing, technology, healthcare, and others. One difference from the S&P 500, however, that this index excludes those stocks in the financial sector, such as commercial and investment banks. Technology stocks currently make up almost 60% of the index's entire composition. A comparison of risk-adjusted returns since the inception of the Nasdaq 100 was in 1985. Let's compare average annual returns of the S&P 500 versus Nasdaq 100 versus Dow Jones from that year. S&P 500 risk-adjusted return from 1985 to 2023. The S&P 500 has achieved an average annual return of 11.2% a year. The long-term standard deviation, which is a measure of volatility and risk, is around 20%, so the return-to-risk ratio is 11.2 divided by 20, which equals 0.56. The higher this ratio, the better the risk-adjusted performance. Nasdaq 100 risk-adjusted return. From 1985 to 2023, the Nasdaq 100 has achieved an average annual return of 13.65% a year. The long-term volatility is approximately 22%, for a return-to-risk ratio of 0.62. Dow Jones risk-adjusted return. From 1985 to 2023, The Dow Jones Industrial Average has achieved an average annual return of 7.7%. The long-term volatility is approximately 15%. For a return-to-risk ratio of 0.51. Please note that past performance is not predictive of future performance. Navigating the investment seas. Now that we've familiarized ourselves with these indices, you might be wondering how we can use them to our advantage. Well, the answer lies in exchange-traded funds. Exchange-traded funds, ETFs, your ticket to the market. Exchange-traded funds are like magic carpets that allow you to ride the waves of the stock market without diving headfirst into individual stocks. By investing in ETFs that track these indices, you can enjoy the benefits of diversification and convenience. SPDR Dow Jones Exchange Traded Fund. If you want a piece of the Dow, look no further than the SPDR Dow Jones ETF. The ticker symbol is DIA. This fund mirrors the performance of the Dow Jones Industrial Average, S&P 500 Exchange Traded Funds. With offerings from SPDR, ticker symbol SPY, and Vanguard, ticker symbol VOO. S&P 500 exchange-traded funds are a popular choice among investors looking for broad market exposure. Whether you prefer the convenience of the SPDR ETF or the renowned quality of Vanguard, there's an option for everyone. Invesco QQQ ETF. Do you want to invest in an ETF that delivers exposure to companies that are at the forefront of cutting-edge, transformative, long-term themes? Then the Invesco QQQ ETF might be right up your alley. The Invesco QQQ ETF tracks the Nasdaq 100 index, giving you access to the performance of the 100 largest non-financial companies listed on the Nasdaq. Happy investing and see you at the next video.